Good afternoon, everyone. I will wait 1 minute before we start, as we still have some people joining in. Thank you. Good afternoon, everyone, and thank you for joining us. It is a pleasure to welcome you to this virtual event. I'm Alessandro Sanos, the Global Director for Commodities and Strategy at Refinitiv, now part of the London Stock Exchange Group. Today, our leading gas analysts will present you their views on how the market are shaping up to the summer season, and will discuss the impacts of the current geopolitical uncertainty. Unfortunately, due to some unforeseen circumstances, our guest speaker will not be able to join us today. All presenters will be pleased to answer your questions. So should you like to ask them something, please do so by using the small Q&A box on your screen. We will try to answer all of your questions, but in the event that we will run out of time, do not worry, as we will be following up directly with you via email. And most importantly, know that the content which will be covered by our analysts is available in Icon. Should you not have an Icon yet, or should not already be a subscriber, do reach out to me and we will grant you a complimentary access for 1 month. But before we start, let me cover a few housekeeping items. At the bottom of your screen, you will find multiple widgets that you can use. You can resize them and move them around to get the most out of your screen space. And to spice things up and make things a little bit interactive, we will have 2 polls. So please do participate and share your views on the market. Should you need to jump out of the webinar to take an important call, do not worry, as we are recording the session and we will be sharing the link after the event. We will also share the link to register to our Power and Gas Fora, moderated by experienced Reuters journalists. This fora, exclusive to Icon subscribers, provide a unique opportunity to test and challenge ideas, gauge industry feeling, and seek peer reaction on the latest market developments. But before we start, allow me a few technical suggestions for the best viewing experience. To save bandwidth, consider closing any program or browser sessions running in the background. I would also recommend to log off from your VPN, as some networks cause slides to advance more slowly than others. And if for any reason the slides are frozen on your screen, to refresh the page, please strike F5 or Command R if you are a Mac user. So without further ado, I'm incredibly pleased to introduce our speakers. We have Wayne Bryan, Director of European Gas Research, Anne-Kat Breivik, Director of LNG Research, and Marina Tsigankova, Lead Gas Analyst. But before passing over to Wayne, let me launch the first poll. So where do you assess the average TTA day ahead will be over summer 2022? Below 75 euros per megawatt hour, in a range between 75 and 100, or above 100 euros per megawatt hour. So I will give you a couple of seconds to be able to answer. Already see more than 30 people already submitted. We are now up to 70. So where do you believe the price will be of the TTF day ahead? We had 150 submissions so far. Let's wait to get to 200. 190, almost there. Okay, so we have more than 200 now, 250. Let's see. So about 6% below 75 euros. Let's say 50% in a range between 75 and 100 euros, and 45% above 100 euros megawatt. So with these numbers, now I would like Wayne to start his presentation and have some comments on your views. So Wayne, the floor is yours.
Thank you, Alessandro, and good afternoon or good morning, depending on where you're based. And sorry, there's a technical hitch here today, so I can't share my camera at the moment, so I'm just speaking, unfortunately. So yeah, firstly, let's just start off by, again, I welcome everyone here today, and we're here to present our findings for European gas outlook for this coming summer. Now, just before I start, I just wanted to say that typically we publish our report prior to having this webinar, and that is the normal way we go about business. But due to current market volatility and, of course, the announcement regarding storages yesterday, actually we did first publish our report, and then once these new findings come out, we had to make some changes. So we'll now look to publish that tomorrow morning. So apologies there. And I think, as you could all appreciate, the way this market's been moving so fast, that yeah, it probably wasn't a surprise that happened on the day we were about to publish. So yeah, apologies to everyone, and it will be available on Icon tomorrow. Firstly, in terms of the poll, thanks for everybody for responding. And yeah, I mean, I think most people seem to see prices staying elevated, and in most cases staying above 100 euros a megawatt hour. I think day ahead today is already up a little bit. I think it's about 117. And I think if we look at how the market's been moving over the last 6 months, we've seen tremendous volatility and sort of prices we wouldn't believe. I'll just move on to my first slide. And this is just looking at TTF, MBP, JKM, and looking at a few things that have happened. Now, I think what we saw in winter 21 probably won't be repeated in terms of the volatility, wide range of prices, and some of the geopolitical concerns I think hasn't been observed before. I think if we start in Q4, I think what we see at the start of sort of Q4 last year, markets started off a little bit softer on good prospects of, you know, healthier storages, good Russian supplies. And then what we saw then was we saw Russian supplies start to fall. We then all started to follow the auction results like never before, and I think it was in part of everyone's routine just to see what Gazprom would book. We had the Nord Stream certification concerns as well. And I think we then started to see a really bullish action sort of November time, December, when not only did we have some of these concerns that I was talking about, we had the start of the geopolitical concerns with the situation at the Poland-Belarus border. And I think that's when we started to worry about future flows and, of course, what may happen at the start of the year. Of course, prices then rallied to what we probably would have thought at the time would be record highs we'd see for a while. And of course, as we moved into January, weather conditions normalized. We saw a lot warmer weather, so we saw a big reduction in heating demand. We also saw renewable strength very high across Northwest Europe, wind especially. We had several storms, etc., that really ramped up wind production. And also the flurry of LNG. Once more, an LNG armada came to the rescue due to TTF trading at really strong premiums to Asian prices. I think, and then once we got to sort of, I think the 24th of February, the invasion began, and then the price then just started moving parabolic. I think for me, some highlights was some of the moves, some of the sizes of the moves. We saw the biggest one-day move on the front month, up 51% or 45 euros per megawatt hour. On the downside, we saw a 36% fall. While MBP, I think the biggest shock was when it traded at 800 pence per therm intraday and then closed at an all-time high of 511. Ever since then, we've seen huge swings in prices. I don't think we've seen volatility like it. And as you can see sort of below the price chart, previous high points of volatility, the start of last year, Also as well, earlier on in Q4, as I mentioned, when prices spiked, and you can see I've highlighted that. And then, of course, again, volatility has increased once more. And if you look back to even just a year ago, we've never really seen volatility at these levels. Similar story with some of the volumes. We've seen a lot stronger volumes now on these markets. But I think one thing we can safely say is this volatility is going to continue. And even what we saw yesterday with the news around the storage, which Marina will talk about in more detail, and of course Putin demanding that suppliers pay for Russian gas in rubles, and again that's added another layer of complexity. And of course, we're still not sure how that's going to work. Is it a contractual breach? Most contracts are already denominated and signed for in euros. So again, it's creating more concern, and there's already some seeing it as a reason to sort of get out of Russian gas contracts. So lots of more volatility is definitely expected this summer, and again, moving in tandem with sort of these geopolitical concerns. And of course, while the war still continues, there's nothing is off the table, including sort of damage to any pipelines, etc. So yeah, the price action has been remarkable this year. Just looking again a bit closer and looking at probably the spread, which really sort of tells a story. Typically, as we always know, and I was just looking back into this, we always know that the summer typically trades, below winter to incentivize storage injections. That's not been the case this year, and we first saw murmurs of this towards the end of last year when it started to sort of switch, but we never would have imagined to see summer at a 66 euro premium to winter, which happened, I think, about the 7th of March when the prices were actually at their highest. And if we look at the premium on average, since the 23rd, 24th of February, we've seen this premium average 18 euros per megawatt hour, which again is unprecedented. And if we're talking about these new storage mandates, it's going to be interesting to see how the spread sort of reacts to that, because at the moment, if we're talking about looking to fill storages to certain levels, then obviously the spreads need to sort of represent that. And at the moment, you'd be loath to inject any volumes into storage to take out of the winter, looking at current price spreads. So again, this is something that firstly highlights the sort of risk ahead this summer. And of course, it can disincentivize these injections. So it's definitely an interesting scenario that's actually unfurled over recent months. And it had started to sort of slow down over recent days, but the last 2 days' moves have seen that spread rise from, I think it was around 6 euros. It's now about 11 euros. So again, problems ahead indicated not only by the fundamentals, but also by looking at pricing as well. Looking at some of how in terms of moving forward for our balances, I'll highlight a couple of key elements of that. And I think firstly, if you look on an overall viewpoint, you can see what we're expecting this summer. A lot less Russia, less Dutch production, of course, increases in UK continental shelf and Norwegian output as well as stronger LNG. Consumption actually has been an interesting part, an interesting component even of our analysis, and we've seen a quite big fall in consumption year on year. But there's been a few reasons why we expect that to happen. And I'll go through that. But yeah, this is looking this summer in terms of the main points. This is where we see the base case scenario changes compared to summer 21. Looking at UKCS, UKCS is forecast to increase. Let me just go back. Let's skip forward. UKCS is actually looking to increase this summer. One of the main reasons we see this increase is because last year, if we're looking summer on summer, last year we had an extraordinary maintenance schedule, whereby a lot of maintenance that was scheduled in summer before, in summer 20, was rolled over due to COVID-19, social distancing and restrictions, which meant a lot of these planned works couldn't be done. So last year we saw, probably the largest maintenance schedule we've ever seen. And if you look at the consumption, it was very low. I mean, it slumped 24 MCM versus summer 20. This year, we expect that to rebound. What we see, of course, the maintenance schedule is nowhere near as high. We have a bit of extensive maintenance in June, which is what we see as the low point. And of course, we expect some additional maintenances to happen as well. National Grid will publish their full maintenance plan on the 1st of April, where we may see a few amendments, we've kind of tried to sort of factor in some additional unplanned maintenance into our forecast. We've had 6 new field additions since last summer. These have arrived since Q3 20. We've had Columbus, Arran and Finlagen started up in 2021. And then recently we just saw the Saturn Banks project get off the ground, and we've seen some production from Blythe and Elgood into Bacton Terminal. And there's another field, Southwark, which should be online towards the end of Q3, which will add additional volumes also into Bacton. So that's some good news there. And finally, Harbour Energy's Tolmount field will be coming online in Q3. Their investment call last week alluded to that. That has also been beset with problems, I think mainly electrical problems. So that will also be coming back online this summer. So we have a lot more positive outlook for UKCS this summer, and it will kind of more be in line with what we sort of saw in sort of 2019. Obviously, 2021 was heavily impacted. Moving on to consumption. Now, this is we see a big reduction here. If you look at total demand in Northwest Europe, it's expected at 51 BCM, which is a 6.5 reduction versus last summer. In the UK, similar story. We're down 2 BCM to 26 BM from last summer. What we're seeing here is definitely industrial demand has started to fall, so we're seeing impacts from that. Renewable output, as I mentioned, in both Northwest Europe and the UK has been really strong this year. And if you look at the charts, you can see, sorry, not the chart in front of me, but on our service, you can really highlight the differences in over the last 2 years. So that's really helped offset some strong levels of consumption, especially from the gas to power sector. Also, we've seen coal has been high as well. With the way the coal switching price looks at the moment, we see gas is completely out of the money, and we expect that to continue throughout this summer. And of course, weaker LDZ, but also you have to take into account with LDZ that last year, April and May were significantly colder than usual. So it kind of exacerbates that LDZ reduction. And we've also used some demand disruption on our, not only on our non-LDZ and industrial, but also on LDZ demand. I mean, there's a couple of reasons around that, which we explain in more detail in our report. One thing we do see as well is German gas-fired generation has really started to fall. And that comes despite a 50% drop in nuclear as well. What we saw this year so far is it's down about 26%. Some of that is obviously due to the conditions as well with stronger wind, etc. But also as well, the strong levels of coal-fired generation are keeping sort of gas out of the stack. We also expect for this summer, there will be a renewable capacity increase in Germany on wind and solar and biomass. So we expect even stronger production from renewables this summer. Also, as well, we must be aware that that is one of the sort of parts of the forecast that's quite hard in terms of the intermittency of wind. If we look at sort of normal wind levels, they fluctuate quite a lot from summer to summer. And we had that instance with last summer compared to the summer before. So that's one thing we need to sort of bear in mind is intermittent renewables can't always deliver what the capacity says. We've also got French nuclear output as well. I mean, it's an annual thing with the French nuclear reactors, but this is actually would be the lowest output in the past 5 years if we follow the advice given by EDF, which they lowered their forecasts or their range for this year to 215 terawatt hours. So again, that is another concern rolling into this summer. But we do expect a big drop in consumption, which really helps with our balance, and it's definitely needed this summer. One thing that's definitely quite visual and quite obvious is the slowdown in industrial demand. Now, as you can see here, I've chosen a couple of instances. We can look at the German non-LDZ, which also obviously includes the gas for power, but we know that German industry's definitely slowed down. We saw Yara cut production at their plants by 55% in France and Italy, and they cited price level and volatility as the reason why. And we've seen that in a lot of industry. UK industry has been heavily affected, and you can see here we've really fallen. We've seen a lot of these energy-intensive industries, whether it be chemical producers, ceramics, etc., all curtail production at some point or even halt it when prices became really high. And now we're going back up again. we're going to expect more demand disruption. And again, we factored some of that into our forecasts as well, because we do expect that to continue. And you can see, even if we follow on from the end of last year, if you look at 21, you've seen the demand disruption was already started. So I think for us, that is going to play its part, and also kind of explains the drop we're seeing year on year, which seems quite large compared to previous years. But again, if prices continue to rise like they have the past 2 days, or they go parabolic once more, as we've seen, then again, we can expect further disruption in the industrial sector. And again, the geopolitical developments are going to play a huge part this summer across many different guises. And this is something that's going to not only price, but also industrial demand, perhaps even flows, which Marina is going to cover further on in this presentation. So good side of the story here is the falling demand, which is needed when you look at the external problems that we're facing in the gas markets right now. Now, one thing that I am hoping for, and we've been promised actually, is an additional 4.5 BCM of LNG this year. And that's something that we're all hoping for. So I'm hoping that Anna Cat is now going to explain to me why we're going to get this additional LNG. And even more to the point, can we get any more if needs be? So yes, over to you, Anna Cat.
Thank you very much, Wayne, and warm welcome to all of you. Thanks for joining. And yes, Wayne, there is in fact potential for more LNG to Northwest Europe than a base case of 4.5 BCM. But as always, that comes at a price, literally speaking. And as you know, there are several structural obstacles in a way, or features of the global LNG market. And one thing is contracts. And for countries outside Europe, about or more than, in fact, 75% of their LNG imports is covered by medium or long-term contracts. But for Europe as such, the similar percentage, that is about 50%. And based on the current situation in the European gas market, this enormous fight for uncommitted or spot cargoes will likely continue. And the tool for winning that war, that's pricing. That's the success criteria. So let's just take a look at some prices. What I've been plotting here in orange, you see the Northeast Asian spot price, and in blue, the TTF front month contract. And so far this year, by and large, the TTF has been trading at a premium to the Asian spot price. And as you have seen, record high LNG into Northwest Europe. But this has the flip side. We have seen some demand destruction in Asia, particularly South Asia, but also, I would claim, in China, because of these high LNG spot prices, as many of the countries there are sourcing some of their, or partials of their supply from the spot market. And also, I say that this increase in flows into Northwest Europe has also been facilitated by a very mild winter in Northeast Asia. When we are going about doing this assessment or trying to find how much of LNG can come to Northwest Europe this summer, we look at the change in supply and the change in demand outside Europe, Northwest Europe, and compare that with the previous summer. But in order to have a good grip on the demand side, we need to have a view on the price to try to gauge the level of demand destruction. And for a base case, we have chosen the price level we saw pre-invasion. And that gives a range of around $25 to $30 per MMBTU. And our base case forecast can look something like this. Historically here, you see monthly LNG imports to Northwest Europe, and the blue line here is base case forecast, taking the total to 25 BCM for this summer. And you see the dip here. That's because of the additional demand we typically see during the summertime for peak cooling in Northeast Asia, but also for the Middle East. And let's now take a look at the different components of this forecast for arrivals. And let's start with the supply side. And we expect to see a growth of about 14 BCM over the summer season. And once again here, you see the United States as the main contributor. And we have seen here the Sabine Pass Train 6 has already started up, and also Venture Global's Calcasieu Pass, which will be ramping up over the summer season. And then we have some minor or smaller increases in several countries across the world. And number 2 here after the United States, and that's Norway. Equinor is planning to finally bring Hammerfest LNG back in production in mid-May. But then we have another interesting one here, that's Russia. You see here, there's some increase in expectations for flows from Russia. And some comes from Yamal. They added a 4th mini train late last summer, and also some additional from Sakhalin 2. They will not conduct that deep maintenance this summer as they did the previous summer. But then comes the question, what about sanctions here? Japan is the largest off-taker of LNG from Sakhalin, and they've said they will continue to take in their long-term contracts. And the same as South Korea said. Taiwan also has some contracts, but that will expire by the end of this month. But all 3 countries have said we are not willing to take spot cargoes from Russia. And earlier this month, Sakhalin 2 placed spot cargo in the market, and reportedly that was sold to a price well below the market price level. So it could look like there's a tiered market for Russian spot cargoes in Asia Pacific. We have to see how that will develop. And then over in Europe, except for Lithuania, all countries have said they are willing to accept Russian cargoes. But the UK will not take Russian ships or ships on charter to Russian companies. So far, so good. It looks like all these, both term cargoes and spot cargoes, can find a home. But then we have this new thing from yesterday with payment in rubles. That will, of course, be cumbersome. But we have yet to see to what extent they can come around this. And that was primarily for countries hostile to Russia, like Japan, Korea, Taiwan, and Europe and the US. But it could be that they can also, Russia could place some cargoes in India, China, and also Pakistan, which has a more neutral attitude. So, but for now, it looks like it's going okay here with Russian volumes. Then let's take a look at the demand side. Here we're expecting a growth in firm demand. That's outside Northwest Europe of 9.5 BCM, so less than the supply side. And once again here, we have China as the largest growth country, but this is very different from last year. We expect to see growth here of about 4 BCM. That's an increase of 7% year on year. And that is in stark contrast to last summer, where Chinese LNG imports grew by about 20% year on year. And then for China, we have seen a significant slowdown in the economy, also very high spot prices. And there's a further ramp up in the Power Siberia pipeline from Russia, and also some higher domestic production. All of these elements taking that toll on our Chinese LNG demand. And then to Japan, we are a bit positive here. they are planning to conduct some very deep nuclear maintenance during the summer, so they will be more reliant on the CCGTs. When it comes to South and Southeast Asia, you can see how it's rather modest growth. Several of these countries, they are seeing their domestic production dwindling, so they need to replace some of that, at least, with LNG imports. But here we are also expecting that the price level as such would limit the upside for imports here. And then you can see the drop here for Brazil. You may recall last year we saw record high inflow of LNG into Brazil as the country was hit by very severe droughts. And then they were using the gas and the LNG to back up for very low hydro production. And over the recent months, we have seen that this hydrological balance is now approaching normal. So they will not need that substantial amount of LNG and gas to compensate for the lack of hydropower. And that's one of the reasons behind the drop here. We should also bear in mind that Brazil is dependent on the spot market for most of its LNG imports. And then finally, Europe, Northwest Europe, and the major share here, that is demand from Spain. Now, pipeline exports from Algeria to Spain has been reduced due to the stop in the Maghreb pipeline. So they will need to compensate some of that with LNG imports. And additional to that, we foresee some extra into Italy and also into Eastern Europe, Poland and Lithuania. So this was in a way the summary here on the supply-demand side for our base case. But then comes the question, the summer outlook here for Europe is very uncertain. We have got a better grip now when it comes to storage filling, but still the supply side is uncertain for sure. And if Europe should need more than these 4.5 BCM, what can then happen? And we have something we are called demand destruction scenario, where we see up to a maximum of 10 BCM additional to the base case scenario, which can take the total to 35 BCM this summer to Northwest Europe. But for this to happen, we need to see a sustained higher price level, significantly above the pre-invasion level, to induce demand destruction, both in Asia and also in Latin America and potentially in the Middle East, to make this possible. That should be more than enough terminal capacity to receive this. But I have to say that as we have called our report for the summer outlook, this is uncharted waters. We do not have much of empirical evidence to lean on, but we are been looking into the different countries and looking at their potential. So that's in a way the maximum what we think can come to Europe during the summer, but prices will be very, very high. So this was just a little flavour on the supply or on the LNG side of things. So if you're interested, you find our newly published LNG Summer Outlook report on ICON. And then I think I'll leave it to you, Marina, to take us through the supply side for Norway and not to mention for Russia. Thank you.
Thank you very much, Annika, and hello, everybody. And yes, I will go on and talk about Norway and Russia. It's not so exciting about Norway this time. We know that Norway has been maximizing its production, and they stated that they're going to do so. So it's our expectation as well on that level. So it's We expect additional 3.3 BCM from Norway of this summer, and it probably will be also record summer production on the in the past history. But though we know that the troll quota has been increased this year, and also Oseberg quota has been increased this year, we do not. The caveat for this summer is actually lighter maintenances in Norway, because last summer, for example, we know that it's been the summer just after the summer 20, when a lot of maintenances has been cancelled due to COVID pandemics, and last summer it was also one of the heaviest maintenance on the Norwegian continental shelf. Now we are back in a situation where the Norwegians actually saying they will try to minimize the maintenance schedule, and based on their current schedule, which is published on Gaska page, so we expect around 6 BCM of capacity cut, down from 10 last year if you sum all the capacity over the summer period. Also, we see like the profile, so that's of the maintenance, is the chart on the right-hand side, that it's going to be the heaviest maintenances. It's going to be in September, so it's later in a season when probably the need for storage to refill based on the new, at least intended regulation or proposal for storages to be regulated come down. So we only see the shutdown of Troll and Kolsnes, the spike on the chart, on the 8th of June. So technically we see additional supply from Norway, which will help to balance this this very tight market. But still, when we're talking help balance, we are talking about the situation in Russia, and this is a large uncertainty Russian supply, and we recognize that, and it's very difficult to make like the bold prediction, but we try to just to share the thoughts what we think situation can be and the supply can be. But before so, I would also ask you to participate in another polling question, and this is about Russian supply, and it's if we see any disruption to Russian gas flows this summer, which would be the most likely form of disruption. So one is Russia cuts flows to Europe, additional European sanctions target Russian gas exports, damaged infrastructure, or you see no disruption. So we also give around 20 seconds for participants to reply, and let's see results in very soon. 100 people have replied. Let's wait for more. 150. Need 100, 200, 230. We get 250, hopefully. Yes, about 250. Okay, thank you. 270. And yes, the expectations are that it will be some additional sanctions. It's the winner. So technically we have 22% for Russia cutting the gas. 38% is actually the sanctions, European sanctions are cutting the gas, and there is a damaged infrastructure risk and also no disruption. So it's pretty much evenly distributed with the possibilities for more of European sanctions being the reason for disruption. And that's just reflects the uncertainty, because it's very hard to know what's going to happen in this unprecedented situation. And for us, our view, we take that we probably, as a base case scenario, we will continue to see original Russian gas through the summer, but at minimized level. And we saw that since the military operation has started, Russian supply hasn't been disrupted. And though it was a statement from Putin asking to pay in rubles for gas, it was also stressed that they're going to continue to send the gas. And of course, we recognize the risk. But again, we take the view that there are contracts to be fulfilled on both sides, and the buyers need to take the gas, and Russia needs to send this gas. but we aim for Russian to sending, or for buyers to try to minimize Russian take to the take or pay minimum or take on or pay contracts. We assume that the take based on the contractual volumes we have collected, and based on the historical flows, as assuming the take or pay of 80% and excluding the contracts of Gazprom with its subsidiaries, we assume that there is a possibility to minimize gas in the calendar year. Here we take the aim as a calendar year by 25%. So this is our base scenario, and it's actually we already see that the winter has been really down from the previous year. So we continue to see minimized level of Russian supply, roughly in line with what we saw so far in this winter. So this is our base case. And but also there is another uncertainty on top of what the buyers are taking, which we say probably going to be a minimum. And that's another uncertainty is the Gazprom storages. Will they refill? Because we saw that since the last summer, Gazprom stopped to refilling the storages in the facility where it holds capacity in Northwest Europe. And one of the reasons and understanding for that, it was just the push of Gazprom to get the Nord Stream 2. And in the current situation, we think that probably it's the certification has been stopped, halted, and it's probably the pipeline will be laid dead for at least the foreseeable future. It's again a great uncertainty, but say there is no push for Gazprom to kind of to withhold the gas in terms of the Nord Stream 2, but and also there is a European Commission proposal regulation which will require the storages to fill up, and those regulation is particularly aimed for those storages were emptied by Gazprom. Yesterday's the amended proposal actually becomes a bit softer, so there is requirements to get a 74 in stock by the 1st of October. And still, as the process around this mandatory refilling is still uncertain, so the understanding if Gazprom doesn't fill, so there is a risk of losing its capacity. And if Gazprom do so I guess that's at least they get a trajectory of what it needs to be filled up if to apply with the regulation to fill up by 74% and by around 62 in August. And it also means that Gazprom might bring more gas on top of of our base case scenario. So this is just to illustrate what we can see as a base case in case of minimum flows of the covering the contracts, and some possibility for more gas if Gazprom brings the gas in storages. But still, what we're saying, we expect Russian supply to be lower summer on summer, and in our base case is 13 BCM down. As I said, it's around 25% down from the last year technically, and but at the same time it stresses it's a strong drop, but it also stresses that it's probably not there at possibility to reduce this down by 2/3, as also European Commission has proposed or had a target for the calendar year. And now when we pulled all our balances together, or our base case into the balance, so we look at the flexible storages, where the storages will be based the base case balance, where we do expect demand destruction, where we do expect more LNG, more UKCS production, more Norway, a bit of less of Dutch production since there is a Groningen regulation, and relatively heavy drop of Russian supply. So actually, to start talking about it, we can say there is a target for storages this year. It's different to the previous year. Particularly, there is a new European storage regulation might come in force pretty soon. The amended draft was presented yesterday, and this amended draft says there is a soft target actually, as our view 74% by 1st of October, while the average across the member states, 74%, while it should be 80% by the 1st of November. And again, the intermediate level for Germany particularly, it's 62% by 1st of August, 68 by 1st of September, 74 mentioned by 1st of October. And this is a large change from the original proposal we saw 8th of March, where they said 90% by. So just to stress, this is a soft, by now it's relatively soft target. And if you compare where the storages has been historically, by the 1st of October, it's the left-hand side, and the 1st of August, right-hand slide. So we see that it's practically targeting to the last year. So it's only in last year we saw lower level in storages at 70% by the 1st of October. Now we need to increase a bit more at 74. So that's, and the same for August. Practically we saw only 2-3 years where we saw below than 62%. So all in all, its target is relatively soft, and this also reflects on where do we see, based on our assumptions, the storages will be. And again, we're starting with one of the lowest, not the record any longer, but second lowest level of storage inventory in Northwest European storage. And we see that we might comfortably go through their current year's regulations, current year requirements, and the blue dashed line is, say, there is a base case scenario, Russian supply is minimized, and probably Gazprom doesn't bring more additional gas into the storages, and it would be the situation where the regulator needs to pull, to utilize this capacities. It's again, the uncertainty is there, but say this is the case. So we see that the storages are actually full at 81% on the 1st of October. And again, it's helped by what we see of additional supply. It's helped by more demand disruption, or demand disruption we see, which is supported by the high prices. Situation where Gazprom, on top of that, brings even more gas, filling their storages. We see pretty comfortable or close to full level of storages in Northwest Europe. But what's about Russia? I mean, it's a lot of uncertainty. We stress that, and it's very hard to say. Yeah, we saw that when you responded in a poll, so there is still expectation that Russian supply might be halted, and we don't know how much, we don't know for how long. So that's the uncertainty huge. So we made the sensitivity scenario say, okay, there is no Russian supply for the whole summer. Say the contracts, Europe doesn't want to pay in rubles for Russian gas. It's a breach of contracts. There is a stop of supply. We do not believe that it's happened. But yes, just to make the visualization, and that is our red dashed line. It says that we're going to have the storages full at 23%. It's nearly not full filled based on our scenario, and that just illustrates how big dependency on Russia we have in this market. Okay, but probably even if Russian supply stops, we need more LNG, and that means that the European price is going to surge at the levels where you're going to attract all possible LNG because it's a crisis in Europe. And yes, we attract all possible LNG, and we utilize all the regasification capacity in Northwest European terminal. And there we have another scenario, which is like the light blue line here, which fills storages by notably healthy level at 58%, but still it's record low. It might not be enough to go through non-mild winter particularly. So it might probably go with the winter is very mild, but it's just illustrates this situation of security of supply issues and the importance of Russia in this market. So therefore, I guess we see those prices at the level we see. It really explains the market being very volatile to all the news, and we haven't seen the the volatility at the level as before, as Wayne talked about in the beginning. And then we can go to our concluding remarks, what we see from this market. So market cannot be balanced without Russian gas at this point for this summer, but undisrupted minimize Russian offtake sees normalization of the storage situation. So that's the very crucial situation, and therefore market where it is now. So, and again, the core uncertainty if Gazprom brings more gas to refill storages in Europe. If it does, it might be the bearish signal. But at the same time, we see the uncertainty around it, which I haven't mentioned, but also we saw that in the last days, Gazprom started to actually heavily withdraw from these facilities. And again, geopolitical premium and regulatory push to fill storages should keep prices elevated for this summer, particularly in Q2, as we need to get on track on these storages. We're starting the year, the summer at the very low level, and therefore we expect prices to continue to be pretty sensitive to news, to weather changes. I mean, April is a shoulder month. We are very sensitive, the market will be very sensitive to weather in Asia, if it's warmer or not, and of course any supply outages. So through Q2 is more crucial for the market, but say we get there, and then we're probably going to see some potential for downside in Q3. Again, uncertainty is huge, but it's what our balance suggested. But at the same time, even if it's downside, we do not see price falling below maximum call switching range. Now it's around 85 at the current prices. And this is due to such factors as gas demands need to be minimized to reduce Russian dependency in the future. So you don't want to increase the gas demand technically when you're going to squeeze Russia as the biggest supplier out of the market. And there is the strongest target probably for the new year on for the next year on storages, and there is a risk premium around Russian supply to remain. So that's the core conclusions of our outlook, and I just want to say thank you for your attention.
Thank you, Marina. And probably let's dive into the Q&A session. Please send your question using the Q&A widget. I have one here for Ann-Katrin. Ann-Kat, the question is, Ellen, can you give some examples on demand destruction in Asia? Thank you.
Yes, it's in a way some of the same as we are seeing in Europe. I mean, one thing is the switch in the power sector from gas to coal, but also you have more oil and fuel oil plants in Asia, like in Pakistan, Bangladesh, Japan, and they have been looking into running more fuel oil, even though it's more polluting, and initially have been aiming to move away from that. So you have then the power sector, and then you have industry. Like, for instance, we have seen it in India, the petchem industry. Instead of using natural gas, they've been using naphtha, light oil products like LPG. And here it should mention that India is covering something like 35% of the LNG imports from the spot market. So they're very exposed. And also you have the industrial sector in general, that they may reduce their activity or even shutting down. We also saw some nice charts that Wayne was showing what was going on in Europe. And some of the same can absolutely happen here in Asia. But I think that will be a little bit more cautious when it comes to closing down production of fertilizer factories, as they have a huge population here to feed. Like, for instance, in China, demand destruction can also come from the fact that there you have the smaller private companies are importing spot, or they have done it, and using the gas to gaining market share internally in China. But now the price of LNG spot imports is higher than the trucking prices. So if they try to do that, they will lose money. That's also a way of seeing that as demand destruction.
Excellent. Thank you, Ankat. And I have a question from Felix. And Wayne, I would like you to take this one. We already know about EU filling target proposal, but is it expected to combine its objective with withdrawal targets and/or price control measures? Thank you.
Yeah, that's a good question. I think in terms of, we do know about these storage mandates, but in terms of the price, I think what they're talking about over the next few days, and we're going to hear more on this subject, is indeed some form of price control. Now, personally, I don't know how that's going to work, and there's also been talk of collective buying for any of these additional volumes to ramp up the storages. So that is going to prove quite difficult, and I think, like a lot of these measures, I think we're going to see quite a lot of challenges, not only for suppliers, but we're going to see that for the market as well. I mean, assessing trading levels, etc., looking at where you think the price will be in terms of spreads, sort of when will you put that into storage. I think it's going to make quite a lot of significant changes, and I think until we hear the finer details, we're going to be all in suspense, and I think that's going to be reflected, as we've seen over the past few days, in terms of the price. So I think, it will happen, but I don't know to what degree, and I'm quite actually confused as to how they think they can set certain price levels or even collective buying. So it's a very, very interesting point. I look forward to hearing what the Commission, the next proposals will be.
Thank you, Wayne. And as a reminder, the analysis of this team is available in Icon, and if for whatever reason you're not a subscriber, do reach out to me and we'll grant you complimentary access. Marina, question from Jörg. How big is Gazprom's share in Northwest Europe storage capacity?
I was muted. Yeah, but based on what the information we have collected, so if we just take the Northwest European storages, which is practically Germany and Netherlands, where the Gazprom holds the capacity, so we count for around 110 terawatt hours. And this is around 20% of all the capacity Northwest European storages has, based on our aggregation. So this is pretty big share, and this is the stress, also the importance of the need of the regulation and the potential for Gazprom to actually impact on the market using those capacities.
Excellent. And I probably would like to stay with you, if that's okay. There is a question from Ankit with regards to the storage obligation. Ankit says it is 80% or 74% for 1st of November 22.
Yes, I saw it, because I saw also another question about it, just to stress, it's 80%, and it is stated in the presentation, but is the 74 is the intermediate target for the 1st of October, because 80 is for the 1st of November, and also our balance, the base case scenario, so says that we can get to 80 already by the 1st of October. So therefore the focus was actually just on the summer. Taken, yes, we might go to 80 already in the 1st of October. But again, the sensitivity, the uncertainties, the weather, it's a lot of risk around it. And as usually, it's a lot of moving parts which will impact this market.
Thank you, Marina. And Wayne, probably back to you. Can you tell me about price direction prospects this summer and potential impact of the easing of tensions of the end of the war?
This is, it's the golden question is to where we see prices this summer. But I think what we've seen over the last few days, and if you look at the TTF front month, it's already creeped back up over 20%, which just highlights the nervousness in this market. Now, I think if you look at where all this started, I mean, as I mentioned earlier, it started a bit before, but prices really went parabolic as soon as the Russian invasion of Ukraine started. And since then, obviously, we did come back down on an easing of prospects and obviously continued Russian flows. However, that risk is still remaining firmly on the table. There's a whole number of factors that could see Russian gas flows either disrupted, as we mentioned, by damage or by unilateral sanctions, or something coming from the European side, which obviously we highly doubt. So while the invasion remains and there's no de-escalation, I think we can expect prices to trade in wide ranges again, depending on any new news. However, I think if you look at, let's just say there's a complete de-escalation, withdrawal of troops, then I think you'd see prices adjust quite lower. And I think if you saw the poll at the start, not many people said 75 euros per megawatt hour, and I think the range was probably more popular, but I think it would take a complete de-escalation and no interruption of flows to see it sort of below that level. So I think it's just the case of, if we were without the invasion, we'd have seen prices trend a lot lower, because we are in a much more comfortable situation without, if you look at the weather, what's happened at the start of the year, etc. So we're in a better place. Storages were on target to end in a better position than we envisaged at the start of winter. So I think the downward pressure on prices would have been quite apparent. But obviously with geopolitical risk on the table, and with it can affect, again, like with the ruble payment situation that's just come out, that's put more fear and complexity into markets, and will the gas cost more money, etc. So again, there's so many different elements that can affect this price. But I think we're going to stay elevated. And if you look sort of where we are now at sort of TTF front month, we're around 120 euros per megawatt hour. I think we saw a softening back towards 100 or earlier. I think that could be a target if there's no new news over the next few days. And of course, they clear up some of the concerns around these payment terms, and as well as once people start taking into account the new storage mandates, I think we can trend a bit lower if there's no more disruptions. But yeah, it's going to be a rocky ride again, I think. I don't think we're going to potentially touch the highs we saw at the start of the invasion, only unless things really, really deteriorate and perhaps we see some signs of potential intervention or clashes with EU forces, which seems quite far off the table at the moment.
Thank you, Wayne. So let's hope that things will go back to normal.
Yes.
We're past the hour, so probably this brings this webinar to an end. We will come back to questions. There are so many questions in the Q&A chat, so we'll come back to you with answers via email. So thank you for attending. Ankat, Marina, Wayne, thank you for your presentation. Thank you very much.
Thank you. Have a good afternoon.